Good day, grade 12, and welcome back to our second lesson in grade 12, obviously in term 2. And today we introduce the financial accounting of a closed corporation. Now, the aims and objectives is that you will be able at the end of this lesson to define and explain the unique concepts regarding a closed corporation, the founding statement, the members, loans to the members, loans from the members, as well as the distribution to the members. You will also be able to compare your closed corporation and a public corporation, and you will know the difference regarding the formation, the ownership, the distribution of profits, as well as taxation, and also compare the financial statements of a public company and the CC, and you will be able to know the difference. And the textbook is then also the Study and Master, chapter 8. Good. So if you remember correctly, in grade 10 we started with your sole trader or the sole proprietor, and it was only one owner, that one person that owned the business. Grade 11 we did the partnership, and it was 2 to 20 people that can be part of the business, but both of these two businesses are not a legal entity on its own, and the owner and the business is not separate with them, so the owner is still liable in both of a partnership and a sole trader of any liabilities or anything that happens in a business. And even if the business owes money, it is actually the owner that owns money. And in term 1 we started with the private companies, and if you remember correctly, they are a legal entity on their own, and they are the owner and the company are two separate entities and people, so the owner are not liable for anything that the company does. Now we are introducing you to the closed corporation, or in short the CC, and we see that a CC is much easier to form and a much more flexible type of business to run compared to a company. And it was originally introduced years ago to enable smaller businesses to obtain corporate status with a legal personality that is separate from the owners, who are known as the members. So members are the owners of a CC, where you in a partnership partners are, and if you're in a company, then it is the directors and the shareholders that's part of the business. Now, in the recent years, the New Companies Act has made it much easier for smaller businesses to start as companies. Now the CC are actually being phased out, and that you can read in article on page 220. But a CC is still will still be seen in the business world for the next several years, and that's why we are introducing it to you as well, so that you know that there is something like a CC. So why are closed corporations then introduced? The main intention of a Closed Corporation Act 69 of 1984 was for businesses to form a legal entity that is easier to administer than a company, and it's easier to form in terms of the Companies Act at that stage. And another reason is that the administration of a company is very complex. So when people form rather a CC, that was much easier for them and simpler for them and much less expensive for them to operate, and it's easier to administer as well. Now there are certain characteristics of the closed corporation. Firstly, we can see that they are simpler to form than a company, and designed in such a way that an ordinary person would be able to draft up the papers and register the CC themselves. It is also ideally suited for your small businesses because it's cheaper and less complex. The managerial and the administrative requirements are less formal for the closed corporation, It is also required to have an accounting officer. The members of a CC are not required to take an active role in running the business. However, in most of the cases, the members of the CC are also managers of the business, and all members must take part in the decision making process. Now, why? What is the reasons for people to choose a CC as a form of a business? Firstly, it is the legal procedures regarding the registration and the administration are relatively easy, and it is not so expensive. A CC is also a legal entity, and that means that it has a legal persona, thus exists separately from the members, the same way that the company are. The members are have limited liability, which means that the members are not personally liable for the debt of the CC. That is the same as for the company. While in a sole proprietor and a partnership, it is not the same, because they are the partners and the sole trader, they are liable for the debts of the partnership or the business. Then a CC does not have to submit any audited financial statements, but a company do have to do that. It has a legal personality, and it separate its members, and therefore has a continuity. This means that if a member sells his members' interest or dies, there will be no interruption in a business activities. The business will just go on. AGM need not to be held as in the case of a company. You know, AGM is an annual general meeting of everybody, the directors as well as the shareholders, and a CC do not have to do that. However, they must have meetings, and it should be between the members, and it must be on an ad hoc basis. All members take part in the management of the business, and the CC may become a shareholder in other companies as well. Now, here you can just read here that this is the New Companies Act. This is the New Companies Act and closed corporations, and there's also the future of closed corporations. So this will then be page 220 that we've mentioned over there. There it also continues. So firstly, we must have a look and see that there's a founding statement. So any intention to register a CC had to be followed by the completion of a CK1 form, which is then called the Closed Corporation Founding Statement. And this statement had to be signed by all the people that's intending to become members of the CC. And it had then, they have to hand that into the CC registration office. This CK1 document or form will contain then the following particulars. It will have the full name of the closed corporation, the principal business to be carried on by the closed corporation. So they will say what type of business the closed corporation intends to do. The postal address will be there, the physical address of the closed corporation, the full name of each member, and also their ID and their address, the size expressed as a percentage of each of the members' interest in a closed corporation, and almost like the partnership, how much will be the percentage that each one of the members are owing. In a partnership, that's also each partner owns a certain percentage of the partnership. Now, the particulars of the contribution of each of the members to the closed corporation is then any amounts of money that they will contribute, that capital that they put in, a description and a statement of the fair value of any of the property or any of the services that is rendered, as well as the name and the postal address of a qualified person or firm appointed as accounting officer of the closed corporation, and also then the date of the end of the financial year of the closed corporation. When will the financial year end be? Members of a CC is then the owners of the CC, and they are called the members. There may be a minimum of 1 member and a maximum of 10 members in a CC. Only natural persons may be members of the CC, and not a juristic person like a company or a trustee. Every member must then make an initial contribution, and that would be recorded in the founding statement. So they will give a capital contribution to the CC to start that. A certificate of membership will then be each member will then receive the certificate of membership, and that will be signed by each one of the members. And this certificate must state that the members' percentage of interest in the company is, and that would usually be what they contributed to the company. So the operating expense, sorry, I think I've skipped a page here. I've skipped something here. Yeah, there we go. So members, sorry about that. Members' interest in the CC. So the members' interest is then the percentage of the total capital that they invest into that CC. So if we can see in this example, member A owns 25%, member B 30%, and member C 45%, and all those percentages will then add up to 100%. And another way that we can explain then is that Bule, Samantha, and Shuwenga contributed 320,000, 450,000, and 670,000. And the founding statement will then reflect their interest, and that would be the 25%, the 30%, and the 45%. And here is just an activity that you can go through and read through the previous part of the explanation and everything, and just answer the questions there. Now there is loans to a member. Under certain circumstances, loans can be made to members of the CC, and that can only be done if consent is received in writing from all the members. And this a loan to a member is an asset to the CC, because they will have to pay it back, and that will be reflected into the balance sheet also. And it is an asset because it's considered as an investment. The CC may also charge that member which they loaned the money to interest as well. So then there can also happen that there's loans from the members, and the same way it can be that a member decide to make a loan to the CC. Maybe the CC needs some money to grow or to expand or buy stock, whatever the reason may be. So money can also be borrowed from a member. That can be cheaper than to borrow it from the bank or somebody else. And this loan from a member is then a liability to the CC, because the money is owed to someone else, and interest will also be paid to that member. A loan from a member will appear then on the balance sheet, and that will be shown as a liability. Also, a loan agreement will be drawn up. It won't be just on a handshake. So there will be all the formalities that is going together with that. Now, a distribution to the members. The distribution of the net profit after tax to the members is not automatic. So the members must agree to whether a distribution of profits will be made or will not be made. And this distribution will only be made after financial statements have been completed and the solvency and the liquidity requirements are met for the CC. So they won't divide any of the profits before they had a look at the financial statements and see, can the business afford to do any distribution of profits, or must they keep the money perhaps for to continue with the business? A distribution is not regarded as um, as a normal operating expense, but it is rather a appropriation of profits in the transaction with members note in the financial statements. Profits that have not been distributed to members will be regarded as retained income, and that also was part of a company that you've learned in term 1. Comparing then the CC with a company, we can see here's the differences, that a CC is a registered legal entity, and also a company is a registered legal entity. A company, the owners are called stakeholders, and in a closed corporation, the owners are called members. In a company, owners have limited liability or debts of the company, and then in a closed corporation, owners have limited liability for the debts of the CC. So that is similarities there. Continuity of ownership, because shares can be sold. Private company sale or of shares are restricted, and a public company sale of shares are on the JSE. In a closed corporation, the continuity of ownership, because membership can be transferred from one person to the next. Or when somebody died, the business goes on, and that membership are also transferred to somebody else. A private company can have one or more shareholders. A public company, 7 to unlimited amount of shareholders. In a CC, the minimum is 1 member and the maximum are 10 members. In a company founded by completing a memorandum of incorporation, and a CC is founded by completing a founding statement. A company shareholders own shares of the company. In a CC, owners or the members hold membership interest in the CC. A company shareholders' investment in the business is called share capital, and members' investment in a business is, and a CC is then called members' contributions. Shareholders earns profit according to the number of shares that they own in a company. In closed corporation, the members earn profits according to the percentage of membership interest held in the CC. And there's a lot, if you can go on your own pace also through the similarities as well as differences can be seen in this table here. Shareholders or share of profits is called dividends, and members' share of profits is called distribution to the members. A company pays tax on net profit earned before the appropriation of dividends to the shareholders. A CC will pay tax on the net profit earned before remaining profits are distributed to the members. In a company, they have to hold an AGM meeting of the shareholders, and a CC is not required to do an AGM. Only they have to meet from time to time. In a company, directors are responsible for the day-to-day management of the company. In a CC, the members are responsible for the day-to-day management of the closed corporation as well. So in a company, they have to employ the services of an external auditor, and a CC have to employ the services of an accounting officer, and he is drawing up then the financial statements. And a company, the annual financial statements must be audited, and a CC that is not required to audit the financial statements. So there is certain advantages and disadvantages. So this is really a very short lesson, and it's only going to be in one video. Here is just templates that you can have a look at of a CC, and that is how the income statement looks, and there is the balance sheet and as well as the notes. And believe it or not, there's also no exercises for this. So this is just for your knowledge to know what is a CC, what is the difference, what is the similarities, how is the founding statement. And yeah, that is all for this lesson, for term 2 on close corporations.